Hey guys, today we are covering the latest housing update. We're going to cover Redfin's most recent update. We're going to talk about the Federal Reserve's chairman, Jerome Powell, and some of his comments from the most recent meeting that they had. With interest rates at 20-year highs, a supply and demand limbo that's going on in the world, it really feels like the housing market could be broken right now. And as I dig more and more into these reports, I get more and more worried about what's going on in the housing market and how long this thing is going to last. So we're going to dive into it today and show you some graphs and some reports and some quotes from what's going on in the industry over the last week. So we're going to start off with a couple of reports of what's happening with the supply in the market. And this is coming from Redfin's weekly housing report. You can see that active listings of homes for sale are down 19% year over year. You can see that the new listings of homes are down 10% year over year. And also their home buyer demand index. So this is Redfin's demand index showing 4% year over year decline. And this is taking into account, it's sort of their internal index that looks at the request for home tours and other home buying services that are going on in the industry. And you can see that that's down 4% year over year. So it's no surprise that supply is down between 19%, 10%, 4% of all the indicators that are discussing supply. The only thing that gives me a little bit of hope, and not that it's very helpful for investors like Jocelyn and I, but another report that Redfin put out shows that real estate investors are pulling back, and they've bought 45% fewer homes than a year ago. Now, that sounds great, and it is helpful, but this is a quote directly from the report. Investor home purchases fell 45% from a year earlier in the second quarter, outpacing the 31% drop in overall home sales. So everything is falling, right? So demand has virtually crumbled, 31% in overall home sales. But what's interesting to note is that the investor fall off has been greater than just a regular fall off. And so that's where we're at on the supply side. Jocelyn, what are your thoughts about these reports and maybe the investor fall off?
Yeah, I mean, honestly, it doesn't surprise me that the investor fall off has happened because I'm seeing it on my side. I work with a ton of investors, and a lot of them are not wanting to buy houses right now. Personally, I'm not buying. I haven't bought as many properties this year as I have in previous years. And I think there's a couple factors to that. I mean, obviously, your interest rate, but also just the unknowing where the market's going to go next and not wanting to put myself in a bad position for next year. So just really making sure the numbers pencil out. And unfortunately, with the interest rate being so high, it is harder to make those numbers work on investments. And so I definitely can understand why that has decreased so much.
Yeah, and it's interesting to note again that this 45% decline is the biggest decline since 2008. They did note, with the exception of the quarter before, when they dropped by 48%. So pretty massive fallout of investor activity, which, to your point, seems very reasonable, right? When you're buying strictly on numbers and not on emotion, well, that's going to lead to less activity for sure. Let's move to demand here. And the Mortgage Bankers Association released a report that applications have increased in this past week. Which, when you see that headline, oh, mortgage applications increasing, that's an indication that, hey, demand is going up. The reality is it's not that big of a deal. They make that headline, but it's really still, we're so far below where we were last year that the increase really is nominal. And this is Joel Kahn, the Mortgage Bankers Association vice president and economist. He said mortgage applications for home purchases and refinance increased for the first time in 5 weeks, but remained at low levels. Purchase applications increased, but were still, and here's the kicker, 27% lower than a year ago. And as elevated mortgage rates and tight housing inventory continue to weigh on the home buying activity. So we like to post these headlines, or especially the Mortgage Bankers Association wants to post these headlines of, hey, we've had an increase in activity. The reality is it's still so ridiculously low compared to last year that it really isn't making much of a dent into the system. Let's talk about interest rates real quick and what went on with the Fed meeting in Wyoming this past week. So the federal funds rate, which, as we've been tracking, does have an impact on the overall mortgage rates that we experience. And the federal funds rate is the sort of the lever that the feds use to try to tamp down inflation or spur the economy depending upon their goals. Obviously, right now, they've raised the federal funds rate dramatically, but they've been holding pretty strong. As of July, it was sitting at 5.12, and it's been hovering at that roughly 5% federal funds rate for the last 4 months or so. Now, what's interesting, though, is that they just had their annual symposium in Wyoming for the Federal Reserve System and everybody that's involved in decision making with the economy as a whole on the national level. And Jerome Powell, this is, everybody hangs on his words, and he's very calculated in the words that he uses when he gives these reports. And so everybody's listening intently to exactly what he's saying. And here's a few quotes from that speech or talk that he gave during that symposium. Hey guys, if you're liking this video, hit that subscribe button. This is a new channel for Jocelyn and I. We're really trying to bring you guys good information, timely information, showing you charts and graphs and data, as well as give you a little bit of commentary. So if you like what we're doing, please hit that subscribe button. That helps the algorithms. It helps it get shared all over the place, and we really appreciate it. He says, it is the Fed's job to bring inflation down to our 2% goal, and we will do so. We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. He also went on to say, we are attentive to the signs that the economy may not be cooling as expected, and even went on to mention the housing market itself, saying that after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up, which is crazy to think about. And what he's looking at is overall values, right? Transaction volume is down, as we've talked about, at a shocking amount, but he's talking about values that we're going to get to in a minute. He did finally say at the end of his talk, based upon this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold to the policy rate constant and await further data. Now, what's interesting about, now I'm no macroeconomist, I'm just the average Joe investor, broker that's been in the space that's trying to make the best sense of everything that's going on in this world. But it does seem that the data that they're looking at is so far removed from what's happening currently in the market today. And so it feels like the decisions that they're making won't have an effect for another 6 to 12 months. And so I'm interested to see how this plays out. But Jocelyn, any thoughts as you've sort of listened to or heard about Jerome Powell and his latest speech?
Yeah, so it kind of worries me because I really don't see the housing market going down. I mean, why would you expect it to go down when demand is still prevalent? And so if he's waiting for that to go down to start to lighten up the interest rate, not the interest rate, but the Fed rate, then like, is it ever going to lighten up is kind of my worry. And then just with, I, I mean, I don't understand inflation as well as I should, but I just don't see how we're going to reach that 2% goal anytime soon, unless if we have a recession. So I I don't know. It kind of worries me hearing that, but Who knows?
Yeah, I mean, obviously, it's almost like we have our popcorn just sort of sitting on the sidelines watching to see what happens. But it does seem like a daunting task, and that they're stuck between a rock and a hard place between pushing the economy into a full-fledged recession while also trying to get inflation under control. Meanwhile, you have this sort of sector of the economy, the housing market that we're so involved in, just being totally destroyed with the goals of the Fed, which really they don't have anything to do with housing. He could care less about what's happening with the number of real estate transactions that are happening in the market. He has one goal, and he's very focused on trying to achieve that. So it does make me think that this is going to drag out longer than we initially anticipated, and that we'll likely find ourselves in a recession. But I started doing a little bit of research, and I found the CME Group. They have this tool that tries to predict whether or not the feds will raise the federal funds rate. And they have this CME Fed Watch tool. You can check it out. But if you go to their little tool here, they show that the target rate probabilities for September, so on the 20th, coming up here in a couple weeks, that the chances of there being a Fed rate hike of 25 basis points is only 7%. So basically, they're saying, hey, there's going to be no changes this upcoming meeting. Whereas if you go out a little bit further to their November meeting, which is the subsequent meeting, you can see that the chances of a Fed rate hike goes up to 38%. So it's interesting to see that these sort of you got almost bets of what's going to happen in the future with the Fed fund rate. But it'll be interesting to see. But it does feel like the Fed is just saying, "Hey, we're waiting. We're going to wait and see what happens. We're probably not going to make any changes at this upcoming meeting in September, just a couple weeks away." But the market is predicting that, hey, there's probably going to be a rate hike in the future. All right. Lastly, I want to cover just mortgage rates, and we'll blow through this really quick. But the most recent mortgage data that's out, this is Freddie Mac showing interest rates, the 30-year fix sitting at 7.18, which the good news in the market, if there is good news, is that interest rates have come down from their peak at like 7.49 just a few weeks ago. So they have come down, but really, has there been enough relief to really spur any significant amount of demand? It doesn't seem so. So that's Freddie Mac sitting at 7.18, and that's their weekly survey, whereas Mortgage News Daily does a daily survey. And as of yesterday, August 31st, we're recording on September 1st, the daily interest rate was sitting at 7.7% for a 30-year fix. And then lastly, what everybody else wants to talk about is prices. How does all this relate to home values going up or going down? And Redfin reported in their weekly housing report that the nationwide median home sales price rose 5% year over year to $380,000, the biggest uptick in 10 months. And the typical mortgage payment hit an all-time high of $2,649. Imagine that for just the typical average Joe out there homeowner having to spend $2,650 on their mortgage. And you can see that this graph just shows how the relation between last year and this year, showing a 5% year over year increase. So you would expect values to be coming down like they did. This black line represents last year. So you can see that we peaked out in roughly July. And then we seen some sharp declines. And so you would expect that we start to peak out in June, July, August, and then see similar decline. But here we are sort of hovering around this 380 mark. And it seems that gap between the year over year median increase just keeps getting wider and wider. So very interesting. And the last thing I'll point out is that the median, as we mentioned, the median home price up 380,000, roughly 5%, the biggest increase since October. And the sales price increased most in these following cities: Miami at 17%, Newark, New Jersey at 16%, San Diego 12%, Milwaukee 12%, and Providence, Rhode Island 11%. And then home sales prices did decline, but only in a few of the metros that Redfin tracks. Austin, Texas being the highest at 8.7, just shy of 9% year over year decline. Phoenix down 2.5%. Portland, Fort Worth, Las Vegas, and San Antonio all showing a decline in values. But as it relates to the vast majority of the market, of the metros around the country, we have prices continuing to go up. So, Jocelyn, we've covered a lot today. What's your overall assessment of what's going on in the housing market?
I want to say it seems like we weathered the storm, but we might just be in the eye of the storm. I don't know. It could be either way. Could you pull up that Redfin graph that you
Yeah.
went over last? One thing I'd point out is last year we did have the Fed rate change drastically. And so, in my opinion, that's probably why we had such a steep decrease last year. Um, Typically, we're going to see a decrease in the winter months, but I don't think we would see that big of a decrease in a normal year. I think the reason that happened was because last year the interest rate jumped up, significantly, and the market had a halt. But it is interesting that compared to last year, we're up so much, and it almost seems like in the past little bit there's a slight increase in the past 2 months, and that's very rare to see in September, regardless of
Yeah.
what years we're comparing to. And so, to me, that's a positive sign that prices are going to go up. I don't know. I don't know if I want them to go up or down or whatever. I'm just going to take advantage of whatever happens.
Yeah, it's interesting to sort of zoom out, look at the big picture, and realize, oh my gosh, this just is a recipe for prices to continue to go up, at least in the short term, right? Because the supply and demand both have just come down at equal levels. You would think that interest rates would just kill demand. We would have a ton of supply remaining, and that would be a recipe for prices to come down, right? Well, unfortunately, because interest rates have been so low over the last decade, we have so many people that are just unwilling to let go of their 3, 4% interest rates, and they're just going to sit tight. And so instead of having that supply and demand imbalance that would lead to reduced prices, we've just simply had transaction volume going down. We've had both a significant drop in supply and demand that is really just maintaining prices, and having what we're seeing right now is a slight uptick. So we'll see what comes in the future, and we'll report back next week on any new changes. But Jocelyn, you want to close us out?
For more real estate news and investing tips, don't forget to like, subscribe, and share our show with a friend. We will see you on the next episode.